Something changed overnight. While one side of the world was asleep, the other side opened its doors, and the price did not whisper. It exploded. Silver did not drift higher. It did not creep upward in a polite, orderly fashion. It opened violently. It surged. It printed numbers that only days ago would have been dismissed as fantasy. $99 on the open, a spike to 102, and even after intraday pressure, a close near $96, still miles above where the Western paper price was sitting. Meanwhile, in the West, spot hovered near $86. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. And I want to hear from you. Drop a comment below telling me where you're watching from and what time it is in your country right now. I read your comments, and it's powerful to see this community connecting from all around the world. That is not a rounding error. That is not market noise. That is a structural fracture. A $10 premium. Let that number settle in your mind. $10 above Western pricing for the same metal. The same element, the same atomic structure, but two entirely different realities. This is not about excitement. This is not about hype. This is about reading what the market is telling you when the tape begins to split into two languages. On one side, physical demand is bidding aggressively before the exchange even fully wakes up. Recyclers are posting premiums above prior closes. Buyers are signaling urgency. Futures are not waiting for Western confirmation. They are moving first. On the other side, Western volume is thin. Price presses into resistance and rejects. Again, and again, and again. 3 rejections from the same zone. No decisive break. No forceful close above the level that would confirm strength. If you are reading structure instead of headlines, you understand what that means. Until the resistance zone is displaced with conviction. Not a wick, not a brief spike, but a full-bodied close through it. That level is still in control. The market is respecting it. So how do we reconcile these two pictures? Shanghai prints $102, Western spot stalls at $86. Options volatility explodes. Open interest stacks into delivery. Vault supplies remain flat. The answer is uncomfortable. The paper market and the physical market are no longer synchronized. And when that happens, pressure builds invisibly before it becomes obvious. Look at implied volatility. When volatility in options pricing surges above prior spike levels, when it climbs beyond readings seen during previous blow-off moves, it is not random. Options markets are not emotional in the way retail traders are emotional. They are mathematical reflections of expected movement. When implied volatility screams higher, while spot price drifts sideways, that is tension. It is the sound of coiled energy. Volatility at extreme levels means the market is pricing the possibility of violent repricing in either direction. It means large players are paying up for protection. They are not comfortable. Price suppression and volatility expansion cannot coexist forever. One resolves the other. Either volatility collapses because price stabilizes, or price erupts to justify the volatility. Both cannot remain disconnected indefinitely. Now, consider settlement. Open interest heading into delivery stands at levels that dwarf available registered supply. 2 ounces of paper for every 1 ounce deliverable. On paper, that is normal. Futures markets are structured around rolling contracts forward, but normal conditions assume orderly rolls. They assume participants do not stand for delivery en masse. They assume confidence. When confidence erodes, paper claims become less attractive than physical settlement. And that is where things become interesting. The clock toward first notice day is not philosophical. It is mechanical. If positions are not rolled, delivery risk becomes real. If delivery demands rise while vault supplies remain flat, stress accumulates. Stress does not announce itself politely. It reveals itself through spreads. Watch the carry between near and far contracts. In stable markets, future delivery trades at a premium to spot. That is contango, storage, financing, time value. When the near contract flips above the deferred month, that is backwardation. Backwardation is not theoretical. It is the market saying, I need metal now. Not promises, not contracts. Now. We are not fully there yet, but we are close enough that informed participants are watching carefully. Now zoom out. Oil is climbing. Supply discoveries have fallen dramatically over the past decade. Exploration lags stretch decades into the future. Geopolitical risk overlays structural supply tightness. Energy feeds inflation. Inflation feeds hard asset demand. Hard asset demand feeds precious metals. At the same time, Eastern gold imports are printing records. Physical accumulation continues month after month. Sovereign and institutional flows do not announce themselves loudly. They move quietly, consistently, strategically. Western commentary often labels rising gold and silver as speculative excess, momentum, temporary mania. But physical import data does not operate on social media sentiment. It reflects purchasing behavior. Behavior reveals belief, and belief is shifting. Yet caution is necessary. Silver did not hold $100 on the close. It spiked to 102 and settled lower. That tells us there are sellers at higher levels. Profit-taking exists. Risk management exists. Not every participant believes price can run unchecked. Implied volatility at extreme readings cuts both ways. Explosive upside potential also implies explosive downside risk. A coordinated intervention, a liquidity shock, a forced deleveraging event. Any of these could trigger violent retracements. Premiums can collapse as quickly as they appear if physical urgency fades. A $10 premium does not guarantee Western price must rise. It could mean Eastern price falls back toward Western parity. Markets resolve divergence in one of two ways. The lower market rises, or the higher market falls. The direction is not guaranteed. The pressure is. So what do we know, stripped of emotion? We know Shanghai printed dramatically higher numbers. We know Western spot remains below resistance. We know implied volatility is historically elevated. We know delivery pressure is approaching. We know vault replenishment is not meaningfully increasing. We know Eastern physical demand is persistent. We know oil and geopolitical tension are adding inflationary undercurrents. That is the data. What we do not know is timing. Markets operate on their own schedule. Structural shifts often appear obvious only in hindsight. Right now, we are in the tension phase. Two prices for one metal, two narratives, two tempos. At some point, that gap resolves. The disciplined participant does not chase noise. They watch confirmation, they watch structure. They observe whether resistance breaks decisively. They monitor spreads for backwardation. They track delivery notices. They verify vault movements. They separate what the data is saying from what they hope it will say. Hope is not a strategy. Structure is. The world is not static. Monetary systems are not permanent. Commodity flows are not random. Silver is both industrial input and monetary metal. It sits at the crossroads of energy transition, electronics, and monetary distrust. That dual identity makes it uniquely sensitive to macro stress. When physical buyers step in aggressively before exchanges open, when premiums widen, when volatility spikes, when delivery looms, when oil rises alongside metals, you are not looking at coincidence. You are looking at pressure. The question is not whether pressure exists. The question is how it resolves. And that resolution rarely announces itself gently. Because the surface level numbers, $102, $96, $86, are not the story. They are symptoms. The real story is structural strain. In stable markets, arbitrage closes gaps quickly. If one exchange trades significantly above another, traders exploit the difference. They buy where it is cheap and sell where it is expensive, compressing the spread. So why does a $10 premium persist? Transportation costs do not explain it. Minor tax differences do not explain it. Short-term inefficiency does not explain it. Persistent premiums signal friction. Friction can be regulatory, it can be logistical, it can be capital control related, or it can be supply constrained. When physical metal inside one jurisdiction commands materially higher pricing than paper contracts elsewhere, it suggests that access to deliverable supply is not symmetrical. This is where many misunderstand the nature of futures pricing. A futures contract is a financial instrument. It represents an obligation under specified terms. Most contracts are settled financially, or rolled forward. Very few result in actual delivery relative to total open interest. That system functions smoothly, until participants begin to question settlement integrity. The moment counterparties prefer physical settlement over financial rollover, stress migrates from abstract to tangible. You begin to see elevated premiums for immediate delivery, backwardation threats, rising lease rates, tightening vault reports, increased account suspensions for abnormal trading activity, higher margin requirements, exploding options pricing. These are not conspiracy signals, they are stress signals. And stress does not need to reach catastrophe levels to produce repricing. It only needs to shift probability distributions. Consider the psychology embedded in a $10 premium. Buyers paying that premium are not acting irrationally. They are valuing certainty over discount. They are saying, immediate possession at $96 to $102 is preferable to paper exposure at $86. Why? Because certainty has gained value. In calm environments, certainty is cheap. In unstable environments, certainty commands a premium. Now think about the resistance zone in Western markets. 3 rejections from the same band without decisive closure above it. That is supply defending territory. It may be algorithmic. It may be hedging flow. It may be positioning defense. The source matters less than the behavior. Until that zone is breached with conviction, Western price remains structurally capped. So we have Eastern urgency and Western defense. This is not the first time markets have diverged geographically. Historically, commodity stress often appears first where physical demand is strongest. Financial centers can lag because paper supply is elastic. Contracts can be created more easily than metal can be mined. Mining output does not double overnight. Recycling flows cannot surge infinitely. Exploration pipelines span decades. Supply elasticity in physical commodities is slow. Paper elasticity is fast. When demand rises abruptly, paper absorbs pressure first. If demand persists, eventually physical tightness overrides paper elasticity. That is the long arc. But arcs can be long. Short-term traders focus on hourly candles. Structural participants focus on monthly vault trends and macro capital flows. Both lenses matter. Confusing them creates error. The near-term caution remains real. A failure to hold triple-digit pricing signals overhead supply. Profit-taking is rational. Elevated volatility increases the probability of sharp retracements. Delivery pressure could dissipate if participants roll smoothly. Premiums could compress if logistics normalize. There is no guaranteed straight line higher. However, structural shifts are rarely neat. When energy markets tighten simultaneously with precious metals, when geopolitical tension overlays supply fragility, when inflation narratives reawaken, when sovereign accumulation persists quietly, when derivatives price extreme movement before spot confirms it, you are not observing random fluctuation. You are observing a system recalibrating risk. Recalibration does not happen gradually in smooth increments. It often happens in bursts. An exchange session that opens $10 above global pricing is not routine recalibration. It is shock adjustment. Shock adjustments create feedback loops. Higher prices increase margin requirements. Higher margin requirements stress leveraged participants. Leverage stress can trigger forced selling. Forced selling can create temporary downward spikes. Downward spikes can invite new physical buyers. New physical buying can reignite premiums. Volatility begets volatility. This is why emotional discipline matters more than directional conviction. The data must be monitored continuously. Is registered supply declining? Are delivery notices increasing? Is backwardation confirmed? Is implied volatility expanding further? Are premiums widening or narrowing? Is resistance finally displaced with strong body closes? Is volume confirming breakout attempts? Each of these questions has measurable answers. The disciplined approach is not prediction. It is observation and response. Now consider macro backdrop. Monetary systems globally have expanded balance sheets dramatically over the past decade. Debt loads have climbed, interest rate regimes have shifted rapidly in recent years. Currency volatility has increased. In such environments, tangible assets regain psychological relevance. Silver occupies a unique niche. It is affordable relative to gold on a per-ounce basis, yet volatile enough to attract speculative capital. It also has critical industrial applications in energy infrastructure, electronics, and emerging technologies. That dual demand channel amplifies stress when macro conditions tighten. If industrial demand remains resilient while monetary demand increases, supply chains feel pressure from both sides, and supply growth is slow. A sudden spike to $102 in one major exchange is not just a price event. It is a signal that buyers were willing to transact aggressively. Even if price retraces, the memory of that transaction remains. Market participants adjust expectations. Risk managers revise models. Volatility surfaces shift. You cannot unring that bell. Meanwhile, Western markets must eventually reconcile with global flows. Capital is mobile. Information is instantaneous. Persistent spreads invite repositioning. But repositioning requires catalysts. Sometimes that catalyst is a breakout above resistance. Sometimes it is confirmed backwardation. Sometimes it is a failed delivery cycle. Sometimes it is an external geopolitical escalation. Sometimes it is currency instability. Sometimes it is none of the above, simply exhaustion of sellers. No one can dictate which catalyst emerges. What we can say is that divergence increases the probability of catalyst. Two prices for one asset is unstable equilibrium. Equilibrium demands convergence. The convergence could be violent. It could be gradual. It could overshoot. But it will not remain indefinitely dislocated. Shanghai's surge to $102 and the persistent $10 premium over a stalled Western $86 price are not isolated curiosities. They are stress fractures forming in plain sight. Volatility is elevated. Delivery clocks are ticking. Physical demand is asserting urgency while paper resistance holds the line. Somewhere between those forces, resolution is building. Whether it comes as a breakout, a retracement, or a disorderly repricing, the structural pressure is real. Read the data, watch the spreads, monitor the vaults, strip emotion from analysis. In markets like this, survival belongs not to the loudest voice, but to the clearest mind.